I'm seeing a couple distinct trends developing with the overall stock market and the price of gold. And I think that these trends are setting up for some great opportunities for investors to make some money. And I wanted to talk about those on today's show. I'm Alan Barry Laboucan. I'm the host from AlanBarryReports.com. And as I said, I'm seeing these two distinct trends, and I've sort of been seeing them evolving for the past few months now. One of those trends that I'm seeing happening is the overall stock market. I've been talking a lot lately over the last couple months about how I watched the overall stock market sort of get toppy, then get what I would say was, quite overvalued, and then even get to the level of priced for perfection. That was when the Dow hit around 15,000, its 52-week high, which is 15,542. That's on an intraday trading during the day number, and it's down to 14,932 right now. The S&P 500, it was as high as 1,687 in the intraday high, and now is at 1,614. And NASDAQ was as high as 3,532 and is currently at 3,435. And so what's happened is those exchanges have come off about 3% from their highs. And some more technical indicators that I watch very closely is I also watch closely how much that those markets are above the 200-day moving average. And they're about, I would say, somewhere in the neighborhood of about 15% over that 200-day moving average. So that's another very important technical indicator that says the market is overpriced right now. Now, whenever I look, I'm kind of a hybrid when it comes to how I look at the markets. Some analysts, they look at the markets and they only really look at either what the charts are telling them or the technical indicators are telling them, or what the fundamentals are telling them. And I blend those two disciplines together. And how I use that is, for example, I've just given you some of the technical indicators that I'm seeing that are pointing towards the valuation or the market being overpriced, or as I was referring to earlier, priced for perfection. And now I'll take a look sort of at the fundamentals of the market too. When you look at the trailing earnings, price to earnings ratio, and I think that this is a very important metric to keep an eye on. Ultimately, over time, where earnings go, so goes the market. And what you pay for a stock relative to the earnings, which is your price to earnings ratio, can be very important in how well you do when you're buying and selling stocks. And so I think that the price to earnings ratio is very important. And right now, on the S&P and the Dow on a trailing basis, you're looking at about 15 to 16 PE ratio, which is getting pretty high. It's getting around the historical averages. But then, to really appreciate why I say that the market is priced for perfection, then you also want to look at what the growth of earnings is. The growth of earnings and the price to earnings ratio combined are very important. When you've got the market trading at 15, 16 times earnings, but the growth of those earnings is only at about high single digits, so maybe 8-9%, that is where you get into what I would refer to as a priced for perfection kind of a market. Now, if the earnings were quite stronger or the PE ratio was lower, then I wouldn't be making the case that you're seeing this price for perfection kind of a scenario. And whenever markets get priced for perfection, it's always a time that you want to be careful and be preparing for a correction. I think there's a couple ways that you can prepare for corrections. There are, one, if you've been long the market and have enjoyed a very good run over the last year and a half, taking profits is one way to build up cash to prepare for for a correction. Another way is if you sort of invest on a regular basis, sitting on the cash instead of putting it in the market right now is another way to sort of prepare for a correction. And another way is there are some very good ETFs out there that they are short ETFs. So if you think that the S&P 500 or the NASDAQ or the Dow are going to go down, these ETFs will actually go up. They're bear ETFs, and there's some out there that trade at 2-3 times what the market does, and those are ones that I think you can do very well in when the correction that I think is coming, which is somewhere in the 10 to 15% window. Now, I'm not suggesting that we're going into a major correction where it's prolonged over a long period of time. I got very bullish on the market in the latter part of 2011, was bullish all throughout 2012, was very bullish even into most of the first quarter of 2013. The reason back then was that if you looked at the price to earnings ratio back then relative to the earnings growth, the market was very cheap. Now it's got sort of price for perfection. I've gone from the opposite position. I've gone from very bullish to now I'm bearish in the short term. But I'd have to also add in that I only think that this is a short-term situation. There's a lot of good things that are happening with the economy. Consumers are gaining confidence. They're starting to spend more money. We can see that in the housing numbers, in the retail numbers, in the auto sales numbers. They're all improving. And I think that ultimately what will happen because of that improving is that you'll see that companies have to react to the added demand for their products, and they'll have to start hiring. So this all creates a very positive situation. But I'd like to see a correction come in between now and the next rally. And I think as bull markets go, it's really healthy for the bull market. Markets can't go up or down in one direction. They have to have breathers in either direction, and I think that that's what's really necessary right now. Now, some things that could affect this correction from happening and make me wrong in my analysis is that, one, the best argument that I hear out there right now is that there is a lot of money on the sidelines right now, and if that money on the sidelines, and there's been more recently because in the last few months, a lot of investors have been selling their bonds that are having very poor yields and sitting on that cash as well. And the argument goes that, well, if that starts getting, what are the assets that it can go to? And right now, if you look at the global asset base, U.S. corporations and their stocks are a very good place to put your money, as the argument goes. And so they feel that, that if this money comes off the sidelines, it will push the market up even higher. Now, I think that gets a little bit overblown, because during the bull market of the rally that started back in late 2011 and continued throughout 2012 and until recently, that there was also during that period of time a high level of cash on the sidelines. And so I think that cash on the sidelines is fairly cautious right now. I hope it continues to stay cautious, because when you get a flood of money into the market, what can happen is it will create a big surge in the price of stocks, and those investors will be getting in at very high valuations, and likely to see the market turn on them, and then they'll be down quite a bit. I hope that these investors that are sitting on cash on the sidelines continue to sit on cash on the sidelines, wait for pullbacks, wait for bargains to come around, then take advantage of the dips. I think we'll get those dips this summer. The summertime is often a time when you can see these kind of big moves happen. There's less investors out there. More people are going on vacation. More pros are going on vacation. So there's less volume. And in a less liquid market, you can get some big swings. We've had some big swings to the upside. I think the most likely big swings now are to the downside for the overall stock market. And so that's one trend that I'm seeing that I think that investors can make a lot of money on. Another trend that I'm seeing is what's happening with the price of gold. In the last 52 weeks, we've seen gold up just about $1,800, and now it's down just below. It got to just below $1,200 just a few days ago, a couple of trading days ago, and I think that what's happening here is that as when the market sort of gets overly exuberant and markets are going up, sometimes they can get overly negative on the way down and just beat things into oblivion when the fundamentals actually indicate that that's the opposite of what should happen. Some of those anybody who follows gold or gold stocks knows that they've been really punished. Whether it's your big cap gold stocks like a Barrick Gold or a Goldcorp, or your tiny little gold stocks, I follow a lot of those. They've all been beaten down, and whenever a sector gets swept out throughout, regardless of the size or the quality, that's usually an indicator that the market is trading on a lot of emotions. And I think that's exactly what's happening with the price of gold, in the gold, physical gold itself, and also the gold stocks. Now, we're seeing a lot of what I would say is on the price of gold, it is really being controlled right now by the paper market, the futures market, the options market. It's not being valued based on supply and demand. If the physical supply and demand were governing the price of gold right now, I would suggest that gold would be quite a bit higher. Now, I watch a lot of business news television, and I see all the talking heads, and they'll talk about gold, and they never get gold right. They're too negative when it's down. They get too positive when it goes up. And right now, practically every talking head on BNN or CNBC or any of the other business news channels that I follow, they're all negative. And when all the pros are negative, that's a great time to get bullish. Now, what I think that they're losing sight of is they get emotional, and they get their opinions going, and their swings to too much optimism, too much negative, based on what the paper market is telling them is happening. And I think that the paper market can take control of the price for a certain period of time, but sooner or later, supply and demand, just like for every other commodity, is going to take over. And when it comes to supply and demand of gold, you really have to watch what's happening in with the gold miners. Right now, you look at the price of gold at $1,200, and there is a lot of gold producers, the biggest producers, that are having serious problems making money at this price. There's a lot of marginal mines that are losing money at this price. This can't continue, and what will happen if it continues is they will shut down those mines that are losing money. If they were to do that, squeezes the price of gold, demand goes up, the price goes up. Now, you also can see signs of the long-term strain in the supply chain from what's happening with the production numbers that are coming out of these major mining companies. If you look at the major gold mining companies and you look at their average head grade, This is the grade that comes out the other end of the mine. This is a grade that you get when you're finished mining. And the head grades have been in decline for some time now. We're looking at a few years now where the head grades are starting to decline. Why that happens is it means that these mining companies have to go lower into the ground for lower grades of gold, and that's why the head grade is in decline. I mean, I remember getting into the business in the early 1990s, and back then, if you talked about a 1 gram per ton gold deposit, that was considered very low grade, and not too many people wanted to hear about it. Now that's becoming the average 1 gram per ton gold deposits, and so the situation where these gold mining companies have to continue to mine gold at lower and lower grades and go deeper into the ground and go into more difficult jurisdictions to find that gold and produce that gold. This is why the supply chain will continue to be constrained for many years. And at the same time that these gold mining companies have had to go deeper and lower grade, their costs have gone up a lot in the last 5 years. And that's why, I mean, I remember back in the 90s, we used to talk about gold, the average gold production cost about $200, $250 an ounce. Now you're talking about well over $1,000 an ounce, well into the $1,400 an ounce on some of the marginal deposits. And it doesn't matter what commodity you're looking at. Whenever that commodity gets down to the cost of producing it on average throughout the world, it's time to get very bullish. It always turns around from there, because the reality is there's a lot of people that continue to want to own gold. You need look no further than India. India and the developed economies, we're seeing a lot of buying pressure coming from the United States as well and other places. There was a time not too long, about a month ago, when they were talking about the difficulty the U.S. Mint was having in getting enough gold to produce all the gold coins for the demand that they were having. Now you also see the biggest buyer of gold is in India. And when Indians they buy no matter what. It's very important to their culture to own gold. And when they can see a price like now, $1,200 an ounce, they're buying it very aggressively. Same thing's happening in China. Even though people are talking about an economic slowdown in China, there's a lot of rich people out there in China that can still afford to buy gold, and gold is an important part of their portfolios as well. I often get a chuckle when I hear some of the talking heads on TV, business TV, talk about, well, there's no intrinsic value in gold, and we can't determine how much revenue, how much dividend it pays, and stuff like that. Well, the intrinsic value in gold is based on supply and demand. And when you've got weakened supply, which it has been for the past few decades, and you've got strong demand coming from places like China and India, that's how you value the price of gold, and over the long term. And so there's this good demand coming from China and India and developed economies as well, yet the supply chain is really constrained, and it's trading at its average cost of production. This, as I said earlier, this is a great time whenever a commodity, whether it's oil, whether it's gold, silver, copper, uranium, diamonds, whatever the commodity may be, when it gets down to the cost of producing it, it's time to get bullish. And so then you go down the food chain from the producers, and you look at the mines that are in development, and there's not enough of those to keep up with the pace that the gold mining companies are mining out gold every year. And then you look at further down into the exploration size companies, and there's not enough money going into exploration, and there's not enough new discoveries to build enough, to add enough to the deposits that are getting built, which is not enough to meet the amount of gold that's getting mined out every year by the gold mining companies. And so whether you're looking at gold from a technical perspective, it is technically very oversold right now on all indicators. Then you look at the fundamentals of supply and demand, and it suggests that it's going to go higher. Now, there is a wrinkle in this argument that I think could make me wrong, which is whenever the stock market seems to get beaten down, investors these days are jumping on the U.S. dollar. That makes no sense to me. The U.S. dollar there is a commodity as well. It's got ample supply. They're printing the U.S. dollar like it's going out of style. One of the things that values the U.S. dollar is how much the debt situation, and they're printing debt like they're building up debt like it's going out of style. The deficit and the debt, national debt, is growing dramatically, running about $1 trillion deficits annually. There is lots of arguments that the U.S. dollar is overpriced and that the fundamentals of the U.S. dollar aren't very attractive, but what inevitably happens when the stock market goes into correction, which I think it's indicating it should, a lot of investors, instead of jumping into hard assets, which I think would be a better move, or at least going into the currencies of the countries that have a lot of their economic growth dependent on commodity production, like Canada, Australia, New Zealand, Brazil, these countries, or even I would make the argument that the euro would be a better place right now. Instead they're jumping on the U.S. dollar. So if one of my predictions comes correct, which is that the stock market is overvalued and ready for a correction, are investors going to keep on jumping on the U.S. dollar, which, you know, all commodities are priced in the U.S. dollar. So if the U.S. dollar is going up, all the commodity prices are under pressure. So there are some contrary indicators there, but I've always been a believer that you want to stay on the trends that you know are the ones that are going to win into the future. I'm not going to mess around too much with the U.S. dollar because it's not trading on a lot of fundamentals right now, and that's a very difficult situation for me. I think that there are a couple markets here that, when I'm talking about the overall stock market or the gold market, that kind of should be doing the contrary thing. The stock market should be coming down, and the gold price should be going up. You know, if that happens, I mean, my hindsight's not 2020, or my foresight is not 2020, but I've always stuck to my fundamentals because they've always given me a situation where I'm right more often than I'm wrong. Sometimes I have to look at my crystal ball up there and for more added guidance. But as I said, right now I'm seeing that the stock market is significantly overpriced and ready for a much more significant correction than we've seen so far, and that gold is very oversold, and the gold stocks have been pummeled even further. So dependent on what your sort of risk tolerance is, if you're a fairly risk adverse person, I would suggest looking at the big gold producers like a Barrick Gold or a Goldcorp. Goldcorp is one of my favorite because they're the lowest cost producers of the big gold mining companies. I like Goldcorp a lot. So that's another way, that's a way to play gold moving up. Gold, there's gold ETFs out there. There's gold coins you can buy. I prefer gold stocks. I like to buy gold stocks because you tend to get a better valuation of gold gold is cheaper when it's in the ground than when it's above ground. And so I like to buy gold mining stocks, especially the smaller ones. I think that they've been dramatically beaten down. And in the future shows, I'm going to try and bring some of those companies' executives on to talk about what they're doing to try to enhance shareholder value, and maybe bring some good ideas to you. So that's the show for today. I just wanted to talk about two key trends that I think are about to play out over the next, between here and the end of the year. I think in the short term that the stock market will go into a correction, and then in the last quarter of the year have a strong rally. I think that in the next coming months, that gold is very oversold, and by the end of the year, it's going to be quite a bit higher than where it is today. And I think that the quality gold stocks out there are going to be much higher than they are today as well. So again, those are some key trends that I think investors want to be paying attention to, because I think if they give a lot of opportunities for some exceptional performance for your portfolio. On that note, I'll wrap the show up and say I appreciate you checking out my website at www.allanbarryreports.com, and have a great day, and we'll talk to you soon.